So now it's time to wrap up our case study because we have to talk about foreign exchange risk management, and then the last topic will be about tax optimization schemes, techniques, and after that we have to create the sample presentation. So these are the jobs for today and for the next seminar. So based on the data created last time, so last week at the lecture when I did all the possible simulations, macro modeling and stuff to get some possible or foreseeable foreign exchange rates, we can see that, okay, so our exposure is in US dollar and it will happen only in 2025 and 2026. But we are more precise, so we are trying to create forecasts for the next 5 years ahead. And our preference is depreciation because only our revenues are real. Actually, it's my revenues because I'm just using legacy components or close to legacy components, so that's why I don't have expenditures in US dollars, I have only one in euros. And if we need data, then we can go to the futures market. So this is what I downloaded last time, that we can have such bid-ask data. So in this case, we have to go for the bid numbers or values. We have also the historical trend, which suggests that during the foreseeable future, there will be a depreciation in terms of the euro. And also at the same time when I did the simulations, then this is what I was able to come up with. And also the macro model was saying that there will be some kind of a depreciation, so okay. And when we had to define the preferred exchange rate movements and the forecast, then we were able to see that while the company would operate better under a small depreciation of the euro, we can test all the possibilities. So this is what we will test. Possibilities derived from the simulations. So in this case, we can see that what happens in depreciation, expected, and appreciation scenarios. So when okay, we can see that this is not depreciation, or this is extreme depreciation. What we can see here, that this is probability is at 5%, and the other one is also an extreme scenario, so appreciation. Another probability of 5%, so the expected is highly probable, the rest is not. Then, significance of the exposure. So, in this case, we can say that how can we determine the significance? What is the impact on value, profitability, probability of default? So, I think this is the most simplest approach. So, let's just create. Did we had already? No, we don't have. Okay. FX exposure. Already we have this Excel sheet here. So what happens if I'm just copy and pasting it on the Excel? Nice. So from or Garch Monte Carlo simulations, we have this data set. So after that, we just have to assess its impact on value and probability of default. Again, these will be years. So in this case, we are just writing here the value, and here we are other sheet. So we have to do the same job what we did in case of the funding, that we have already set funding strategy, so now we just have to explore it. Foreign exchange exposures impact. If it would be not euro but other currency, we could also explore the impact of funding the companies through foreign exchange denominated loan, but in this case it's irrelevant, so maybe I should change the case study in the future because we lost one option to explore. Anyway, so we should have, yeah, this is the exchange rate, which is 1, which is not that great because we have dynamically changing exchange rates. So did I use this up somewhere? Ah, I used it there. Nice. So in this case, we have to see that and also before doing anything, then we should see that without any changes. So no change. Plus 1. So this is the current scenario. In this case, we can compare all the issues. So let's jump for the valuation, which is a nice amount of money. And also let's go for default. Which are also really nice percentages. Maybe I teach it to use percentage. Yep, now we can start to play. So it would be so nice if we would have a row here and we just had to add the exchange rate. Oh, there is a row here, so we can teach it. So right now we just have to still keep it 1, but let's use, I did not use red color yet, so this is the other red, so in this case we can remember that these are linked to each other. And now we have to see that, okay, this green should go down. I8. So instead of using I8, we will use this C40. And the rest is, they are also defined by the column, so nothing should change if I'm just executing. So again, I was just referring back to this Euro-USD exchange rate from this line. Updated, nothing happens, so that's why we can delete this. So C line 40. Okay, now we define that this is where our exchange rates are living. So now we can dig in and we can say that instead of using 1, then let's refer on the expected scenario. Tip, 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 tip. Go through. Did I destroy my financial runway at least? Let's see. No, it's even better. Yeah. The slight depreciation created small profit for me, which is cool. Yeah, and also my financial rivalry requirement decreased because I'm using only equity funding, I think. Yes, share issuance was the selected scenario, so that's why I saved up a lot of money in paid interest, so that's why I'm not in huge losses anymore, only in just in 400 million. Okay, so this is what happened when we are using the expected scenario, so let's check valuation. Valuation should not be that much different. You can see it's slightly increasing because depreciation happened, and also we have to look for the probability of default, which is also completely the same. So we are really close to the 1-1 exchange rate, so sorry, to parity exchange rate, so that's why you can see that it would have significant results. Still, this 400 euro gain on the share price is still enjoyable. Okay, then let's see depreciation. So we have to go for 5. So instead of the 6, we are selecting the 5, and then my loss is increased. Maybe I interpreted the whole thing backwards, because this is not depreciation, this will be appreciation for the euro. The depreciation of USD, let's say. So in this case, still we can see that value decreases. Probability of default should not be affected that much. 1% increase here. But yeah, anyway, so still we can see that even if we have really serious depreciations of the US dollars, which reduces our margin, the company is still operational and still has value because we already consolidated the operation. So this is why I'm always mentioning that we should not achieve profitability through exchange rate changes. We should achieve or create value with our assets, not by other ways. Then we should also check the appreciation scenario. So this will be 7. So we are changing 5 to 7. 0. It's overwritten. Then valuation. Obviously, valuation will increase because now the US dollar appreciated a lot. So what's the depreciation in terms of the euro? But again, it had not much impact. So in terms of valuation, we could say that the range of changes is within more than 2000, but that's all in terms of pricing. If we are checking also probability of default, they are the same. So we could say that, okay, in terms of risk, we don't have much. In terms of valuation, we can see that, yes, some kind of fluctuation can happen, but that's all. So let's do it nicely. And let's copy it. Change. Buy more than 2,000 euros. Under extreme FX volatility. What is in terms of percentages? So we should see that, okay, the highest minus the lowest divided by the lowest. And this is a percentage. So it can be 25% change, okay. So this is the highest volatility. So now we have to say that is this significant or not? Okay, 21% change is significant-ish, but these are absolutely the extreme level of changes. But since we have to test derivatives anyway, so that's why we can say that, okay, these changes can be seen. We can consider this one as significant. Significant ones. Okay, and now finally we have the derivatives. And in this case, we have to estimate the option fee. And okay, last time when we had all the volatility data, I was able to extract also the standard deviation from day to day. It was, oh, sorry, from week to week, doesn't matter. And we have such forecast. It would be also really nice if I would also collect the volatility, because it was also forecasted or at least simulated ahead. Because it would be much better, much more appropriate for option pricing, but now I cannot do that because this simulation was only one result, so we should reconsider and recalculate all of our results, and I don't want to do this, so yeah. Gauge model will be completely enough. Then we need also lecture notes, because obviously I would like to have options. We could have Heston. No, we will have Heston. So it's nice, but first we should just see the Garman-Kohlhagen model. So These options, they have transparent option fees, which is really good for us because in this case we can calculate their value. So the problem with futures market is that for futures market we have to put down or pay in margins, which is a non-interest bearing deposit like asset, but we cannot estimate the necessary value. So the brokerage firm or the investment bank will ask for some kind of a money at the time where we are initiating the contract, but I cannot estimate it. So that's why options are better, because option fees we can estimate at least. So we can use options by estimating the Garman-Kohlhagen and the Heston models. Because usually option fees are somewhere between them. So Heston models are more expensive, Garman-Kohlhagen are less expensive. So in this case we can see that. Okay, let's test. And real market-based option fees are following them. Let's add nice equation. So this is for the Garman-Kohlhagen call, and the other one, the Heston, is we don't have proper equation for that because only the processes are described. And then okay, so in case of Garman-Kohlhagen, even we can type it into an Excel sheet. So we could do it. The question is that do we want to do it? But why not? So what we need here is the spot rate. So first of all, okay, so the spot rate is right now, let's go back for the market data and weekly, and where we were here, 1.6, so this one. So the spot rate is coming from here. Targeted rate, we don't want to deviate from this 1:1 ratio, so it's good for us. Also what we need as an ingredient, time in years. Let's use 1 year at first, then we will expand this. Also we need interest rate in euro, we did interest rate in US dollar. So okay, let's go back for the database. From this, the monthly database, we were able to add this one is the euro, next one is the other one. So this was the last known data, and these are percentages, and we should write the percentage mark here because otherwise we have really funny results. And also we need the standard deviation. In this case we will use only the last known data from the Gauge model because we don't have any other metrics, and this one is quite proper. But this one is yeah, the HT, it's oh. Did I include? Yes, I included. Okay, cool. Oh, it's already square rooted, so I don't have to square root it again. Good. Ah, okay, so this is the standard deviation from last time, and after that we can see that all these inputs were necessary. And then we can start to construct. So this now I can't edit it here. So first I would like to build up this one. Then I would like to build up that one. And after that we can go on. So, ln spot rate divided by targeted rate plus time domestic minus foreign interest rate plus yes, standard deviation on the square divided by 2. This is good. This will be the same, just we have to change this plus to minus. That's all the difference. I put it here, so in this case it's more visible. Then, after that, we have to go for the next component. The whole stuff. We could go faster as well, just in this case I'm trying to minimize the potential errors and mistakes. Divided by the multiplication of square root of time and this is the same for the other. Just in this case we have to save it. Okay, this. Then we have to use so is this probable under normal deviation or not? That's you. I think this is the We will see. After that I will run a cross-check in MATLAB to see that did we do everything in the proper way, because this was dubious. We're not supposed to use normal inverted. But at least we know that where the bug can be. Oh no, this is minus. So okay, so now we just have to say that exp minus foreign interest rate multiplied by time multiplies the spot rate and multiplies the number here, and it's not working. So instead of here we need the Euler number. Instead of using the exp, then because exp is the MATLAB function, and now it will work. Yeah. Okay, now we have to do similar. Just this one will be referring not on the foreign interest rate but on the domestic one, and it's referring not on the spot rate but on the targeted one, and also on the other normal distribution, and this is also negative, so otherwise they are completely the same. Okay, then. So call option fee supposed to be the sum of this number plus this number, and then we should pay for such amount of euros for each US dollar. Then let's see. So we need such a data. Okay, we don't need any 4 cycles here, just simple stuff. So we need the spot value, which is this number. We have the target rate, targeted value, which is 1. We have the domestic, so euro interest rate. I already mentioned that we should be really careful, because usually this is where I'm making the mistake, or I have huge potential to forget it. This is the USD interest rate. So here we have to say that it's 4.4. And then we need the standard deviation. And number of years. Oh, And still I have to remove these. So you can see that same thing is happening, that non-CDF was used. What I have done here? Did I use... I should use the cumulative distribution function, but yeah, I said true, so I was using the cumulative distribution function. Then let's see. Which? Yeah, because this one is invalid. Okay, so the European coal price should be 0.414. Is this correct? Wow. I did it at first time without any bugs. This is not that usual. I would be say that this is always the case, but not much. And also, in terms of pricing, you can see that if we are just taking this addition here, then we can also get the put option. So now let's create also the put option fee. If we are already doing this, then we should do it nicely. So equal European coal plus targeted rate minus the spot rate, bracket closes, multiplied by the Euler number. Okay, then I need to collect the Euler number from here. Euler number, and here we have again the negative domestic interest rate, it's already there, and also the time. Put option fee should be, oh, this says it's close to 0 and the other says it's negative. So where is the typo? Ah, sorry. Yeah. Targeted minus not spotted, this is the F, which is all these things here. So spot rate multiplied by EX speed RD minus RF on square root of T. So all these things, just here we have RD minus RF. F, and then multiplied by time. So now it's the same. Oh, I'm so proud of myself. And now we can do the same thing for 2, 4, 3, 4, 5 years ahead. So right now I would like to buy all the options. I don't want to care about any exposure, just let's buy it. So how can we do this? Obviously we just have to create the spot rate, target rate. With the current information, we are just going ahead. Option fee should be more expensive as we are going ahead, because we have to pay more and more money to compensate the risk taking for the vendor. Yeah, so put options will change. Call option decreases because yes. So in this case, this one is the compensation. Okay, now the next thing is that which one to choose. So right now we have to sell US dollars to buy euros, which means that we have to use call options. Oh, no. This is put option because we are selling the US dollar and that's why it's more expensive, so we have to look for this one. So we have to integrate all these things into our model. So instead of using this euro US dollar exchange rate anymore, we have to set it to 1. But also at the same time we have hedge expenditures, so we have to set it here. This number. But the problem is that, okay, this is just for 1 unit of US dollars and we have multiple of them. So we have to multiply it with the number of unit price in US dollar, USD revenue. Oh. This number multiplied by this number. So in this case we can realize that how much US dollars we have, because after that this is already recalculated in euros. So here we don't have anything, and after that we have for 6 million US dollars, so the other is, I mean 6 million euros, we can do it, so it's not that terrible. Okay, so let's copy it here. So hedge expenditures, and after that we can add the usual valuation and things like this. Or should we extend? Maybe we should extend the existing sheets because Garman-Kohlhagen. So we have value. Valuation did not change at all. Probability of default. Also, I think it was not affected. It shouldn't be affected, yes. Okay, so Garman-Kohlhagen, we can do it, we can sleep well, but at the end of the day we don't have much problems. So we have, in this case, if we are using the option, we have the chance to increase the value from this to that, but that's all the trade-off. So we should assess that does it first spend such amount of money and we should spend this one today. So this one is not even correct, because it shows us that this will happen only in these years, but now we should. How can I do this? Yes. I was able to hijack them and just put it there. So it's not the most elegant way, but in this case we can say that. Yeah. This is only happening in the first year, because right now we are adding all our hedge related expenditures. And let's just check that is this counted as expenditure. Yes, it is. Yeah, so it's negative just. So okay, so that was the Garman-Kohlhagen, which is easy, so we can do it even in Excel. The problem with first was Garman-Kohlhagen model, and the next will be Heston. Luckily we don't have to run this. So data against spot price, target price, so we just have to copy and paste already. And I don't. Oh, I have to run this one as well. Yeah. Or should I? No, I should not. I still create, because we already have the necessary data, so let's create a more refined version of this script. First, loading the data, so spot price was already, we know that, so it's 0. Strike price, so the target price is 1. The rate, which is the domestic interest rate in euros, is 100, and because we had to modify the original function, the div is the foreign interest rate. Okay, settle date. We have to set the dates, but at the end of the day we just change the year and it's good enough. Okay, majority is 1 year. It will be put option. Volatility. Okay, right now we can see that this is coming from this database. And also we can see it in the lecture notes, so we have to define the following values. So we need, is this variance? Ah, this was variance. Okay. So last known variance, which is sad because here we have only standard deviations, so I have to take this number and I have to put it on squares, and after that it will be variance. Then mean. Mean of the variance. In this case we just have to calculate the mean of the variance, so it's nothing difficult. I will copy it here in the exposure. Large standard deviation, and then variance. So I don't want to calculate again and again the square of these numbers, so it's much better if we are just creating a second column for that. And then what we needed here was, okay, variance less known value. Oops. Okay, the other thing will be the mean of variance. Kappa is that how, if variance goes up, that what is the speed of calming down, and it had a beautiful name in English. Yes. Mean revision speed, yeah, this is what I was looking for. So mean revision speed so volatility of volatility, STD of variance, and correlation between returns and variance. So still we need returns as well. Okay, so for this one we just have to calculate the mean. Yeah, that one is not working. So not necessary. So this is all the code. Okay, mean of variance, we can estimate all of them because this was the last known. Mean of the variance, we just have to say that a mean function or average function or whatever is in Excel so this is the long-term value, which is really close to the standard deviation or variance that we can calculate on the data. The problem is that right now I will need also if foreign exchange rate because we don't have it right now. But I can have this one because minus that one. This is not a date. Yay! Is this real? I mean, does it changing or just... Okay, so maybe we should copy. These numbers. How it's changing. Okay, then we have to move this upwards, and then we can see that this is the graphics. Okay, so now it is proper in terms of time indices, so yeah, everybody is at the same time. So mean of variance, this number, and after that there is this mean revision speed, which can be only estimated by this equation here. So the standard deviation of the standard deviation must be estimated, but it's easier if you start here with the standard deviation of the variance. So standard deviation of the variance is provided, and after that, okay, let's copy it. It will be really long. So standard deviation of the variance divided by 2 multiplied the mean of the variance and plus a small number 0.001. Okay. Now we have all the necessary inputs. So mean of the variance was this one. Obviously decimal points. Oh, I should also type here kappa. V0, that was theta V, and also sigma V. No, sigma V is standard deviation of the variance. Okay. And this one is this number, and also still we need row SV. So the correlation between returns and variance. So in this case, core rel this one, and the other one. They have zero correlation, so it's quite simple. And then we just have to execute all this thing, and then it fails because I don't have time variant index changes. Yeah. So this is the value right now for the put option. So how should we do this? So I should change the numbers here. And also here as well. Okay, so Heston put option fee price PI. So it's even more cheaper, but if I'm starting to tweak it upwards, so running it for 2 years, running it for 3 years, or and the last one is 5. Then we will get higher and higher values. Can we say that, okay, these are numbers, but 4 digits? Oh, cannot say, because right now these are decimal points instead of decimal commas. Here I can also change it to have nicer formatting. So what you can see that yes, they are more expensive. Not much, but a bit more expensive. And now we can do the same thing with them. It was 66. Now it should be 70. So 70 here, 70 there. Yay! So instead of 6 point something, now the hedge expenditure will be higher. Doesn't necessarily, because we know that we summed it up, so this one plus this one. So actually 1 million euros more expensive if we are using the Heston option fee. So if we are writing out options, then usually it's much better because it provides us a way more conservative approach. But at financial risk management, we will have a whole class about just about Hestons and option pricing. So this was just an introduction that this is how we can do it. But let's see that does it have any contribution. So in terms of valuation, now Heston. It's a bit smaller. In terms of default, I think it will be the same. Yes. No, 1% increase. So they are the same. Top. So if we have to change or see the difference between these two plus this one minus this one, just to see that, okay, what is the average difference? So 30 euros per share should be the average difference if we are using options. This is how value will decrease. It's not that surprising because the Madura book suggests so share value decrease if we are using options. So Madura book says that maybe so companies should not do hedging because their investors will do the hedging. So this is the case that I usually don't like, because it's for companies it's way easier and cheaper to do hedging than for retail clients. But at the end of the day we can see the effect here. So So now we just have to write the skip this one. So we are assuming that we will buy put options to sell or US dollars in the second year, second and third year. Years right now. If we are using Garman-Kohlhagen option pricing, the cost Can I put here as okay, let's remove the rows, let's remove this column, and now we have the and also create Kohlhagen and Heston option pricing, and we don't need BUD. We can expect the following option fees. Oh, and one more thing that we have to add also here. We have to add meaning for the columns, because otherwise it looks stupid. We are buying options now. So we will be supposed to spend between 6 points and 7.22 million euros for hedging the first year. We are doing it, and after that to fix for Euro USD exchange rate at parity 1. Nice. Then valuation will have an impact. Value of the company can be lower due to hedging. So we have the or we could say obviously that we are shooting for this one, so this the appreciation exchange rate, and then we are just increasing it. But okay, I wanted to do hedging, not right ahead head first speculation here. So it's a small price. Compared to the potential. How much money was that? So if you are going between this and that, yeah, 2016 euro. The under non-hedged. Okay, and also we can see that the probability of default was not affected. So okay, so as conclusion for the case study, we can see that so we have the following option: not hedging or total hedging. Total hedge. If we are not hedging, the value can change by 216 euros. So I mean the share value. Or it can be over by 30 on average. Or under total hedge. Therefore, management chooses total hedge as the 7 million euro expenditure the first year. Insulates them. Mitigates, yes. Mitigates the risk of FX exposure and unnecessary share price volatility. Well, it can depend from country to country, company to company, from situation to situation, but in my case, it's reasonable to say that, okay, I don't want to have such drop potential. Okay, we can say that, yeah, the share price could jump or fall from this one to that one, so it's not completely this 2000, because I have this here, and this would be the worst case scenario, but still 1175 is the difference, which is, for me, it's relevant. Okay, even if, oops, if you are just dividing the whole stuff, it's nearly 10% change in one direction, so it's much better to safeguard. In many cases, usually we can say that we don't need this one, but in the current scenario, I can say that I have such an exposure that my setup, my company will need it. So that was all for today.